called vertical bull spread or vertical bear spread. Normally you're used to options being set up as a way to take on very speculative positions, high risk, high potential return investments. Maybe you earn a 200 or 300% return if things go in your favor. Maybe you lose all your investment if things go against you. You can also set up strategies that are a little more conservative, and the vertical bull and vertical bear spread follow that line. So let's go through an example of a vertical bull spread using call option contracts. And we're going to start with some of the following information. Netflix on August 12th is trading at $246. The 240 September call is trading for $19.25. 250 September call is trading for $13.75. Just a quick recap of what we mean by this. This means that the stock right now is trading at $246. If I buy the call option, I'm buying the right but not the obligation to buy Netflix stock for $240 anytime between now and the third Friday in September. Now, right now, that has an intrinsic value of $6. I'm paying a lot more for that because Netflix could go up significantly. If Netflix goes up to $300 a share, I could make a big profit off of that. The Netflix 250 September call, very similar, getting the right to buy Netflix stock, but now for $250 instead of $240. Because I'm agreeing to pay a higher price, the call option is worth less. Now, what I just described was thinking about somebody buying the call option, but there's also somebody that's going to be writing the call option. If you buy the call option, you get the right but not the obligation to buy the stock. If you write the call option, then you are the person that has the obligation to deliver the stock for that fixed price if the owner of the call option decides to execute their call option or exercise their call option. In this vertical bull spread, what we're going to do is we're going to buy the Netflix 240 and write the Netflix 250. The vertical bull spread using call options, you buy a lower strike and write a higher strike. So we're buying the lower strike call option, the 240. We're writing the higher strike 250. When we do that, we're going to spend $19.25. Remember, each option contract, which is the smallest increment we can buy, is 100 options. So we're going to spend 100 times $19.25 for buying the 240. But when we write, we're going to receive the money. We're actually receiving $13.75 per option on 100 options. So our net cash flow is going to be $19.25 or $1,925 to buy the September 240 calls. And then we're going to receive $1,375 for writing the 250 calls. This is going to cost us a net of $250. So we have a net cash $550, a net cash outflow of $550. So that's our initial cash flow. Starting up to set up this position is going to cost us $550, spending $19.25, receiving back $13.75. Now let's look at what happens. Fast forward to the third Friday in September. We don't know what's going to happen to Netflix stock. Maybe it goes down, maybe it goes up. But let's think about some possible scenarios. Remember, we own that 240 call option. We bought that one, so that's to us. But we owe that 250 call option. Whatever that's worth is what it's going to cost us at the end. Our net profit is going to be our initial plus what we own minus what we owe. So our initial, remember, was negative 550. If Netflix falls all the way down to 220, remember, we own the right to buy Netflix for 240. Nobody wants to go out and pay $240 for a $220 stock, so that option is going to expire worthless. We wrote a 250 call option, so we owe that to somebody else. If they were willing to pay $250 for the stock, we'd have to sell it to them. They don't want to pay $250 for a $220 stock, so that's going to expire worthless. So we initially spent $550 to create the position. The option we own is worthless. The option we owe is worthless. Our net profit, we lose our $550 initial investment. The stock price goes to 240. Now, there's no net advantage to paying $240 to buy a $240 price stock. The call option is still worthless. The $250 call option, nobody's going to pay us $250 for a $240 stock, so that call option is still worthless. Our net profit, again, we lose $550. The $550 we spent to set it up, we didn't get anything on the call option we bought. We didn't lose anything on the call option we own at expiration. So our net profit is $550. Now let's say the stock price goes to $245.50. Now we own a 240 call, so we can buy a $245.50 stock for $240. So that's going to have a value of $5.50 per option. The ability to buy a $245 stock for $240 is worth $5.50 per option. Each option contract is worth 100 options, so we have a value of $550 on the option that we own. However, the option we owe to somebody else, remember the one we wrote? That was $250. They're not going to pay us $250 to buy a $245, so their option is going to expire worthless. Our net profit, we initially spent $550. The one we own is worth $550. The one we owe is worthless, so our net profit is zero. This is our break-even point. So we break even when the stock price is $245.50. What if the stock goes to $250? Now we can buy that stock for $240. That's worth $10 per share, 100 shares per contract, $1,000. There's no value in the other people buying the $250 stock for us for $250. If they want to, they can. It's not going to cost us anything either to deliver that. So there's no cash flow there. We have our initial negative $550. We own an option worth $1,000. We owe zero. So negative $550 plus $1,000 minus zero, $450. We make a profit of $450. Stock goes to $270. Now we can buy a $270 stock for $240 with the option that we own. That's worth $3,000, $30 per share times 100 shares. However, now we get hit with owing people something because we wrote that $250 call option. So now other investors can buy a $270 stock from us for only $250. That's going to be worth $2,000 to them. So we owe $2,000. Our initial negative $550 plus what we own $3,000 minus what we owe $2,000 again, is going to give us a profit of $450. That's just negative $550 from our initial setup cost plus the $3,000 from the option that we own minus the $2,000 from the option that we owe. So when we do that, we come up with $450. Now notice what happened here. When the stock went down, it didn't matter if it was $240 or $220, we lost $550. As a matter of fact, you can keep going. The stock price is $100, we lose $550. This is our worst case scenario. Worst case is we lose $550. Notice what happens at $250 and $270. We make $450. Doesn't matter how high you want to take that. That's going to be our best case scenario. So once we get to $250, doesn't matter how high it goes, that stock or that position is going to make us $450. So if we look at a vertical bull spread here, looks like this. As the stock price falls, 240 and below, we lose 550. 250 and above, we make 450. In between there is our break even at exactly 245.50. So that's a vertical bull spread. If the stock price goes up, we make a fixed profit. The stock price goes down, we take a fixed loss. And you might say, well, okay, but this doesn't look good. Our worst case is $100 worse than our best case. Why would we ever want to do that? Well, keep in mind right now, Netflix stock is already $246. Where's our break even? Our break even point was $245.50. So if Netflix stock stays where it is, R goes up, we make a profit. It has to drop by 50 cents before we break even. So most of the time, we'll profit from this investment. That's why we make a little bit less profit and we take a little bit more loss. Depending on how you structure your vertical bull spread, where your strike prices are, where the current stock price is, you can tweak this a little bit to either have a higher potential profit, but less likely, or a lower potential profit, but more likely. We can also do a vertical bear spread. Same idea, but now we're going to flip it around. Consider the following information. We've got Netflix, 246. We've got the September 240 call, September 250 September 250 call. But now we're going to buy the higher strike and write the lower strike. So the vertical bear spread, we buy the higher strike call, and we write the lower strike. When we do this, we'll buy the 1375, 100 shares per contract. 1375 gives us a $1,375 cash outflow. We write the 240, the lower strike. We get $19.25 per option on 100 options per contract. We get $1,925 for a net cash inflow of $550. So now up front we make $550. If the stock price drops 240 or less, both options are going to expire worthless. We're going to keep the $550 that we received up front. If the stock price climbs 250 or higher, we're going to take a net loss of $1,000 on the two option positions, but we already got $550 up front, so our total net loss will be $450. So you can see what happens is we've just inverted the picture with the vertical bear spread. Now we can make 550 if the stock price declines, or we lose 450 if the stock price goes up. So we've just flipped around our bet with a vertical bear spread. We're now betting the stock price will go down, but if we're wrong, we're not going to lose that much. If we're right, we make a little bit. So the idea of the vertical bear spread or vertical bull spread is you don't have the big swings, you don't have as quite a big of a potential loss or quite as big of a potential gain, but you can still make a bet on the direction of the stock. You can also do this with puts if you want, and set up a vertical bull spread using puts. So now let's switch the company around a little bit just to give you a different example. We're looking at Deere, which at the time I made this example on August 12th was trading for $75.10. The 77.50 September put is trading for $5.40. The September 72.50 put is trading for $3.15. We're going to buy the lower strike, write the higher strike. So with puts, remember it's important here, we're dealing with puts, not calls. If we want a vertical bull spread, we want to buy the lower strike and write the higher strike. Now when we do that, we're going to buy the 72.50. Remember that gave us the right but not the obligation to sell Deere stock for 72.50. So the stock is size that put option. If it's above 72.50, we'll let it expire. We're going to write a 77.50 strike. So if the stock falls below 77.50, whoever purchased that is going to exercise it. We're going to have to deliver the stock for $77.50. Up front, because we bought this $72.50, we ended up spending $315 per option, 100 options per contract, $315 cash outflow to buy the $72.50 put. We wrote the $77.50, so we received $540 per put, 100 options per contract, positive $540, net cash flow up front of $225. So when we put on this vertical bull spread, we received $225. Now what happens at expiration? Again, stock can go down. Remember, it was trading at $75.10 when we started. Or it can go up. If it goes down, we have a fixed loss. If it goes up, we have a fixed gain. You might want to work through those calculations, just make sure you can come up with those same results. But the idea is we can do this same bull spread with puts just like we could with calls. Doesn't matter, just you have to set it up how you want. You can see this payoff pattern here. We've got our fixed loss of $275, our fixed gain of $250. Between $72.50 and $77.50 is where we have our sliding scale. So this is $72.50. Anything higher than that, we'll start to lose less. Our break-even point was $75.25. And our maximum profit is going to occur at $77.50, our higher strike. So our lower strike represents the maximum loss point. Our upper strike represents the maximum profit point. And somewhere between that is going to be our break-even. In this case, it's $75.25. Is our break-even for Deere stock. Now you can see the term vertical bull spread comes from the fact that we're making a bullish bet on the stock. If the stock price goes up, we're going to make money. If the stock price goes down, we're going to lose money. When we were dealing with our vertical bear spreads, just the opposite. with a vertical bear spread, we were making a bet that the stock price would go down. That's when we made our profit. If the stock price went up, we took a loss. So vertical bull spreads, vertical bear spreads. Again, you could do a vertical bear spread with puts as well. All you have to do when you're dealing with the vertical bear spread on puts is flip that around. If you're doing a vertical bear spread, then you're going to buy the higher strike and write the lower strike, and that's going to invert the position that you have right now. So these are just some option trading strategies that you can employ. Make things a little bit different than the traditional just buy a call or buy a put. Hope you learned something. Thanks for your time.